Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're unmasking the $35.8 trillion illusion of American home equity. So that number, $35.8 trillion, it's the latest record high for home equity in the U.S. as of Q2 2025.
It sounds incredible, right?
And that sounds like massive, widespread prosperity, like every homeowner is just sitting on a mountain of wealth. But the sources we've been digging into, from research papers to policy critiques, they all argue that this measure is, well, fundamentally misleading.
It's more than misleading. It's really an illusion. The core thesis we're unpacking today is that this huge number, this $35.8 trillion, reflects chronic housing scarcity and, economic friction,
Not genuine wealth.
not genuine national prosperity. And here's the conflict. An individual homeowner, they can absolutely realize that wealth. We'll show you how. But the aggregate housing wealth, that's a theoretical illusion that would just vanish if everyone tried to cash out at once.
Okay, hold on. So you're telling me if I sell my house, the equity I walk away with is real? For you, yes, absolutely.
But if my neighbor sells theirs right after me, and then the person down the street sells theirs, the value starts to collapse. I mean, how big of an illusion are we really talking about here?
It's big. And it's an illusion that relies on only a few people cashing out at any given time. Now, that's true for all assets, the S&P 500, gold, you name it.
But housing is different.
Housing is totally different because it's a mandatory item. We all need a place to sleep.
Yeah.
So the value we're seeing is more a measure of desperation, not abundance. Our mission today is to figure out how this fake aggregate wealth translates into real individual opportunity for you.
All right. Let's unpack this paradox. We can start with what our sources are calling the great decoupling.
Right.
I mean, if housing wealth was real prosperity, you'd expect home prices to move more or less in line with what people actually earn, but they haven't. Since 1984, the lines have just split apart. Home prices are up 5.5 times, that's 5.5 times, while median incomes have only risen by 3.6x. And what's so fascinating about that decoupling is why it's happening. It's not because we're building better, newer, more amazing houses.
No, in fact, the sources point out the opposite. The high valuations are on aging assets.
Exactly. Since 1975, residential real estate value has jumped by an incredible 59% relative to household incomes.
59%.
And to be clear, that's not because the physical house, the wood and nails, is worth more. It's a sign that the land under it, and really the government permission to have a house on that land, are just becoming astronomically expensive.
So we're just paying a massive premium for scarcity, not for quality. And these high valuations, they're really just a claim on future incomes.
Precisely. The sources call it a revaluation of the cost of living. Think about that. People are paying so much more money just for permission to have basic shelter.
Which fundamentally lowers their actual standard of living.
It does. Even if their net worth statement looks great on paper, it's a huge regressive transfer of income from new buyers and, crucially, from tenants straight to existing owners.
And here's the stat that just makes this whole thing click for me. Rents haven't followed this crazy trend.
Not even close.
Since 1984, rents have only gone up by about 7% relative to median income. Compare that to the 50 or 59% surge in purchase prices.
That disparity, that massive gap, is the key. It tells you everything. The price of owning a home is now completely decoupled from the cost of using one.
So buying a house in a high-cost city is less about shelter and more about buying a leveraged financial asset?
A hyper-leveraged, scarcity-driven financial asset.
Yes.
And this breakdown goes right to the heart of how the housing market is supposed to work, this idea of filtering.
Right. Walk us through how that used to work.
Okay, so traditionally the model is called filtering down. When new, better homes were built for higher-income families.
A new luxury apartment building goes up.
Right. The older, maybe smaller homes they moved out of would then become more affordable. They'd filter down to middle income than lower-income families.
So everyone's standard of living was gradually improving.
It was a sign of real wealth growth. But today, because of this chronic, long-term undersupply of new homes, the whole process has reversed.
We're seeing filtering up.
Exactly, filtering up. Wealthier buyers can't find new homes, so they're forced to trade down into the older existing housing stock.
And that just bids up the prices and rents on the very homes that were supposed to be getting more affordable.
And this isn't just a theory. The data is clear. Between 2015 and 2022, rising rents effectively erased 15% of real income growth for the lowest income quintile.
A 15% loss of real income growth, that's That's devastating. But, I mean, isn't there an argument that people are just paying a premium to live where the jobs are? They're trading high rent for a higher salary?
That's a great question, and the sources address it. If the high cost was just about productivity, you'd have a point. But the argument is that this is more like inertia under duress. Families are paying this enormous premium just to avoid being displaced, to avoid the trauma of being pushed out of their communities. They're paying for resistance, not necessarily for a better opportunity.
Which brings us right to the individual homeowner, the one who's trapped. How do you actually use this paper wealth?
This is what analysts call the trapped homeowner dilemma. Let's say you've gained, I don't know, $800,000 in paper equity.
Feels great.
It feels amazing. But if the house across the street, the one you'd need to move into, also costs $800,000 more than it used to, you've gained zero actual purchasing power for shelter.
You're trapped. You still need a place to live.
And the cost of that necessity has risen just as fast as your asset, so the sources are clear. This wealth is only real if you use flexibility to unlock it. Otherwise, it just goes to your heirs.
Okay, so how do you unlock it? What are the strategies?
To turn that paper equity into tangible, usable wealth, there are really three main exit strategies.
The first one's obvious, right?
Yeah, the first is downsizing. You sell your place, move to a cheaper region, a lower-cost state, or just a smaller, less expensive home nearby.
And the second?
Second is borrowing. You access the cash through financial products, things like a home equity line of credit, a HELOC, or for older homeowners, a reverse mortgage.
Okay. And the third strategy is the one that really leverages this whole decoupling mess we talked about.
It is. It's the renting advantage. You sell the home, you take the equity in cash, and you go rent a similar place, maybe even in the same area. It feels so counterintuitive to the American dream.
But the math can be overwhelming.
The math is what makes it so powerful.
Yeah.
Let's take a real-world example. A high-cost market like Jersey City.
Okay.
To own a $1 million condo there, when you factor in everything, mortgage, tax, maintenance, it costs about $8,400 a month.
$8,400. Wow.
Now, to rent a similar unit, maybe in the same building, it's only $4,650 per month.
That is a massive difference. We're talking $3,750 in cash flow every single month.
Every single month. And I know the psychological barrier to giving up ownership is huge, but the financial argument is designed to overcome that.
So you sell the $1 million place, you pocket your equity as cash.
Let's say $300,000 net. And you immediately free up that $3,750 a month.
And you invest all of it, the equity and the monthly savings.
You do, and the compounding effect is it's profound.
Oh.
Over 30 years, depending on market returns, you could end up anywhere from $600,000 to $2.4 million ahead.
That is a life-changing amount of money. So you realize the trapped equity, you exploit that huge price-to-rent gap, and maybe most importantly, you stay liquid. You're not dealing with property taxes and leaky roofs.
You've offloaded all that risk. And this incredible advantage only exists because of the systemic policy failures that created this scarcity in the first place.
Which brings us to our risk segment. How did policy let this happen?
Well, the impulse is always the problem. After a crisis like 2008, or during high inflation, policymakers fall into what the sources call the demand-side fallacy.
They focus on disciplining risk.
Exactly. They try to limit credit, make it harder to get a loan, raise interest rates, all to cool down buyer demand and bring prices down.
But if the core problem is a lack of supply, then restricting credit is it's completely counterproductive.
It makes the problem so much worse. You make it more expensive for builders to get loans, so you slow down new construction. And what happens?
Rents and home prices go even higher for everyone.
You're basically trying to make the country poor enough to match its poor housing supply, instead of just fixing the supply.
And this whole focus on demand is often built on a faulty narrative about what even caused the 2008 crisis. I remember all the talk about reckless overbuilding.
It's a classic misperception. You know, the story about shoddy homes built in the Nevada desert.
Right.
But if you actually look at the data, it doesn't hold up. Building permits and population growth in a place like Las Vegas were actually flat during that period compared to historical trends.
So it wasn't a building boom at all.
No, it was regional supply binding. Zoning, regulations, things that stopped enough homes from being built, that's what caused prices to skyrocket. So focusing on demand is it's looking in the wrong place.
So we've established the aggregate number, this $35.8 trillion. It relies on an illusion. It only exists if we don't all try to cash in at once.
Right. It's a mathematical impossibility for everyone to realize that value at the same time. In that sense, the aggregate wealth is fake.
However, and this is the key takeaway for our listeners, for the individual, the wealth is definitively real.
Absolutely. It is real for anyone who has the flexibility to cash out, use that rent-to-price gap we talked about, and fundamentally change their cost of living structure. The opportunity is there for the taking.
So if the true sign of national prosperity is building better homes for more people, and these high valuations are really just a regressive tax on the basic need for shelter, what should policymakers be tracking instead of aggregate net worth to gauge the real standard of living for the average American family?
Risk defined, portfolio protected.